numbers are coming in right now. The change in non-farm payrolls pretty much in line with estimates, down 125,000 jobs. Remember, the estimate was for a decline of 130,000 jobs. I want to get to Mike McKee now, who's at the Labor Department. Mike?
Well, this was a very interestingly mixed report, Betty, with one very good number. The unemployment rate drops to 9.5% as the economy creates 83,000 private sector jobs. We saw job creation in some of the areas where you want to see it. 9,000 manufacturing jobs added, the sixth consecutive month of gains for manufacturing. And service industries finally started adding jobs in larger numbers, 91,000 jobs added there. However, in terms of wages and earnings, some bad news. A drop of 0.1% in hours worked, about a half hour taken off of that, and a drop of 0.1% in earnings. So the work week a little shorter. Overtime hours dropped by 0.2 to 3.8. So a mixed report, Betty, at this point. Some interesting data inside of it. Construction off 22,000, but not really housing workers, not people who build houses. Specialty retail trade falls, and we saw 225,000 census workers leave the payroll. So the number you'll hear from the administration today is 9.5. The number that'll count on Wall Street is 83,000. A lot of people had thought this might give us a picture one way or the other of whether we're out of recession or seriously recovering. It probably leaves us still somewhere in the middle, Betty.
Mike, thanks. And, you're seeing that reflected in the markets right now. I'm just watching the numbers change in front of me with the futures and the treasuries, and you're seeing pretty much, a range going on right now. You're seeing it taken down just a little bit right after those numbers, but now they're kind of stabilizing. Dow futures still just up by about 24 points. Treasuries, which have been a bit lower, as you can see, look at that, a mixed picture right now in the bond markets. The 10-year yield going down, the 2-year, though, being sold off just a little bit, that yield higher. And as Mike was just saying, this doesn't really give you that clear picture that you thought you might get with this report. I mean, would you agree with that, Guy?
Yeah, absolutely. And I think the market's response is the most confusing aspect of it. And we've seen this kind of trend continue with a lot of the economic releases over the course of the last 2 weeks or so, where the 10-year Treasury actually improves in price, its yields decline, and the 2-year Treasury rises in price, which is actually fairly frustrating for bank profitability in the intermediate term as well.
Right, yeah, they can't make that spread, essentially.
Mm-hmm.
Why is that? Is it just because, we've gotten bad data leading up to this jobs report, though?
We have. I think what we're seeing really on the short end of the yield curve in the 2-year area and even a little bit shorter is a resistance to the absolute low level of returns. When you can buy a longer bond and earn, 3% more than you can buying a 2-year bond, the appeal of those longer investments is just so much greater. And I think we're seeing that come into play.
I see. Mike had pointed out a couple of details in here. I want to get your reaction to that. The hourly wages were coming down. Bad news on the consumer spending front, right?
Yeah, it certainly is. And consumer spending is one of these things that we see sort of tailing off.
Right.
The economic recovery is sort of perceived as being either on or off. But the truth is there's a third stage, which is a transition from the economic recovery into what many have described as the new normal. And I think with this jobs number and with the data out in the last week, that's exactly what we're actually seeing here.
You mean we're hitting this lower growth, essentially?
Right. Long-term level of lower growth.
Now.
That's the new normal, to use the common phrase for it.
Right. The PIMCO phrase. I always think about PIMCO when I hear that. Okay, so given these numbers then, Guy, everyone wants to know how long will it take then? It doesn't seem like it's going to take longer before the jobs market fully recovers all those jobs, the millions, the 8 million or so.
Well, I think along with this idea of a new normal and a slower level of long-term growth, we're also talking about a jobs market that probably has a higher long-term rate of unemployment, unfortunately. So we're really looking to 2012 to 2013 before the jobs market recovers to that new long-term rate of unemployment around the mid-5% area.
The mid-5%, but that wouldn't be full employment yet.
Well, arguably that's the new full employment is what we're talking about.
Okay.